Hello dear students, this week we're going to continue chapter 25, Sources of Finance, with external sources of finance. Last week I explained you the internal sources of finance, which were how a business can find money within itself without going to any external source. This week we're going to talk about the external sources, the outsiders. How can a business find money for expansion, for any payments, for any fund needed from an external source? These listed external sources are 11 in our book, so they're a little long, and we have new concepts and terms that we will learn. So it's important that you read them carefully and to understand them well. First of all, we know that a business will need some more money if they want to make more investment, if they want to expand their business, go into another activities. They may need money to buy more raw materials, equipment, vehicles, buildings, land, and etc. And sometimes there are unexpected payments, taxes, unexpected bills, and economic recession. In these cases, they will need more money than they have in their pocket ready. So they will need to go on and knock some doors. So where can these money come from? Usually we know that this money comes from banks, because banks are enterprises which lend money to individuals and businesses. But we have other options too. So the first one is a bank overdraft. And let me remind you that this external finances can be for short term and can be also long term. So I mentioned before that short term means money that will be repaid in a year or shorter, and long term is money to be paid in more than 1 year time. So if we're going to use short-term credit, if we're going to take a short-term loan, we have to pay it in a maximum time of 1 year. So this can be for 3 months, 6 months, 9 months, and 1 year. A bank overdraft is usually a short-term external source. So what does this mean? We use this money, but we usually repay it in a shorter time than a year. So how does a bank overdraft work? Let's assume that you don't have any money in your bank account, but it may be a checkbook account, it may be a credit card account, or it may be a normal account that you use to transfer money to any person that you have to pay. In this case, your bank can allow you an overdraft. So you go beyond your limit, actually. That means you can spend money that you don't have. So the bank is giving you an amount of credit. After you spend the money that you don't have, you will have to pay that back to the bank, plus with an interest. So we know that interest rate from the beginning of the year, we talked about interest rates. Interest rate is the cost of borrowing money. So if you borrow money, you will have to pay it with an interest. Let's say you borrowed $100 and the interest rate is 5%. It means you have to pay back $105. So it will be costing you more money to pay back. And the benefit you get from that is to have that money that you don't have right now. You will have that extra credit. And let me remind you that I'll be dividing this external sources into 2 videos and to 2 parts, probably 5 in one video or 6 in other video. And this lesson you're going to listen to half of it, and next lesson you're going to listen to the other half. The second one is trade payables. This does not consider the bank. This does not have anything to do with borrowing money from a bank. This is about having to pay your suppliers, because in all of the business we know that we have to buy certain raw materials or supplies or equipment, buy or rent. to do our certain activities to produce our goods and services. So we know that we have to pay back these lenders, we have to pay back these suppliers their money. But one way is to delay these payments. So instead of paying them back today, you may be able to pay back in 3 months' time or in 6 months' time, or divide it into installments, pay monthly and monthly to these back. And in this way, it will be a chance to have some money. Instead of paying them back, you will have an extra source of money to use. So trade payable, or the other name trade credit, is a way that will give you extra sources of finance if you can delay the payments of your suppliers. The third one is credit cards. Credit card is a popular method of credit used not just by businesses, also by individuals. We have this plastic card which has a chip on it, which writes your name, which has the bank's logo on it. And everywhere we go, usually we can use a credit card as a means of payment. In a grocery shop, in a bookstore, in a big department store, in a restaurant, in an hotel, buying tickets, shopping online. The most popular way of making a payment is a credit card. So businesses also can use credit cards, and this gives them a certain credit, because again, when we use credit cards, don't forget that we're spending an amount of money that we don't have. It does not exist. Credit cards have limits. So if you're given a limit of $10,000, it means you can spend up to $10,000 per month. And at the end of the month, with your invoice, you will see how much money you have spent. And if you can pay them all back, you will not pay any interest. But if you fail to pay that amount, the next month you will have the amount unpaid plus a certain amount of interest added to it. So credit cards is a good way to give you an extra source of finance, but don't forget again, if you cannot be able to pay that amount, you will have to pay with interest. The other way of other external source of finance is loan capital. Loan capital loan is the other name for taking a credit from a bank. So you take a loan, you take an amount of money from the bank, you ask for a credit. And after that certain amount of money is given to you, you have a certain time to pay that back. Sometimes it can be short-term loan, which, as we said, it's a maximum time of 1 year. Or it can be a long-term loan, which can go up to 1 year, 2 years, 5 years, even maybe 10 years. So if it's depending on a short-term or a long-term loan, also depending on the amount that you're asking for, the interest rate may change. This means if it's a very long-term loan, and if you're asking a big amount of money, and if you're not securing any property in return, your interest rate tends to be much higher. What does it mean to secure a property? It's also called a collateral. Collateral is when you give a security to the bank, saying that if I fail to pay this loan back, you will be able to take this property I own. It can be a land, it can be any type of building you have, any vehicle you have. So this is called a security. So if there is no security given, it is also called an unsecured bank loan. So if you take an unsecured bank loan, that means that your property is safe and you won't have the chance to lose your property if you fail to pay. But don't forget again that this type of loans are usually for more short-term and more smaller amounts of money, because a bank does not want to risk a very big amount of loan without asking for a collateral in return. And the other type is a mortgage. Mortgages are again popular, not for only businesses, but for also normal households and individuals. In most of the developed countries, most people, the people with a fixed amount of income, usually are able to buy their houses with a mortgage. That is because houses are expensive property and we will need a long time to pay them back. So it's not very easy for someone with a standard income to buy a house with advance money given. So they take a mortgage. Mortgages can go up to 25 years. So you pay them for a very, very long time. And the popularity comes from having low interest rates. Because, again, the bank will hold the deeds of the property as a security. That means not until you have paid the very last installment will you be the owner of your house. And anytime when you fail, the bank has the right to claim the house back. So businesses again can use this type of loan funding to buy big property. Buying very expensive amount of factories, warehouses, land, they can use this type of mortgage payments. And when you get the mortgages, you will pay to the bank slowly for a long time. And if you fail to pay, there is a chance that they may take the property away from you. Yes, this is the first 6 types of external sources of finance. We have 5 more, which I will explain to you in our other lesson. So try to read them from the book and learn the new terms that you've heard for the first time well. Bye bye.